You know that feeling when you open up your investment app or, you just glance at your retirement account and all you see is this jagged, aggressive red line just pointing straight down.
Oh, yeah. It's awful.
Right. It feels so incredibly personal. Like it genuinely feels like the market woke up, looked at your specific financial goals, your timeline, your life, and just said, nope, not today.
It really does. And I mean, it's a profoundly universal kind of dread, and it stems entirely from our evolutionary wiring. We are just desperate for predictability.
Yeah, we want the line to just go up smoothly.
Exactly. We want the graph to be this smooth, comforting green line drifting up and to the right. And the moment volatility hits, that comfort just vanishes. Our brains immediately interpret a financial drop as like an actual physical threat.
Wow. A physical threat. Well, that biological panic is exactly what we are stripping away today.
Absolutely.
Because we are diving into Chapter 3 of Gregory Scola's deep dive into wealth building, the leaking pound, specifically the section titled The Real World, How Markets Actually Behave.
Such a good chapter.
It is. The mission of this deep dive today is to, well, essentially help you talk yourself off the ledge. Scola strips the emotion out of it and replaces it with the underlying physics of market behavior.
Which is such a necessary paradigm shift for any serious investor, honestly. When you're staring at that red line, you're essentially just looking at noise.
Right.
Scola's whole thesis in this chapter is that to survive the psychological pressure of investing, you have to stop staring at the noise and start understanding the machinery underneath it.
An actual mechanic.
Yeah. He breaks this machinery down into what he calls the 3 core forces.
Okay, let's get into those forces. Because on a day-to-day basis, I mean, the market looks entirely random to me. But if we're talking about actual wealth building, there has to be a mechanism, right? Like, what is actually making that line move?
So the foundation of it all, force 1, is economic fundamentals.
Okay, fundamentals.
Right. This is the underlying reality of the businesses you hold. We're talking corporate earnings, GDP growth, interest rates, capital allocation.
The boring math stuff.
Exactly, the math. In the long run, the actual mathematical cash flow of a company is the only thing that drives its value. That is the engine.
Okay, and here's the disconnect for me. If force 1, the actual earnings, if that only really changes every quarter during earnings season, why does a stock swing wildly by like 3 or 4% on a random Tuesday in October?
Right, because the fundamentals didn't change overnight.
Exactly, they didn't.
Well, that gap between the quarterly reality and the daily volatility, that's exactly where Force 2 steps in. And Force 2 is investor psychology.
Ah, okay. The human element.
Yes. This is the aggregate mood of every single human being and, algorithm participating in the market. It encompasses fear, greed, loss aversion, herd mentality.
So it's everyone's feelings basically driving the day-to-day.
Pretty much. Markets aren't just pricing in what a company earns today, right? They're a forward-looking discounting mechanism. They are trying to price in what will happen 6 months from now. And human beings are notoriously terrible at predicting the future without getting wildly emotional about it.
Yeah, that's for sure. So, okay, if force 1 is the actual engine of a ship pushing it across the ocean, force 2 is like the mood of the crew.
I love that analogy, yes.
Like some days they're working in perfect harmony, right? And other days they're completely panicked, running around the deck, totally convinced the ship is going to sink because they saw a dark cloud on the horizon.
That is a brilliant way to visualize it. And that actually brings us perfectly to Force 3, which is external shocks.
External shocks, like what?
These are the completely unpredictable, often geopolitical or macroeconomic events that happen entirely outside of the financial system but violently impact it.
Oh, right.
Wars, global pandemics, sudden massive policy shifts, natural disasters.
So, sticking with the ship analogy, the external shocks are the rogue waves, or, the hitting icebergs, the things you just simply cannot map out in advance.
Precisely. And what Scola points out is that the true test of an investor is understanding how these 3 forces interact during a crisis.
Give me an example of that interaction.
Well, let's look at the COVID-19 crash in early 2020. That was the ultimate Force 3 event. A massive, unpredictable rogue wave.
Oh, man, I remember the visceral panic of those weeks. I mean, the market dropped something like 30% in a matter of days.
It was terrifying for a lot of people.
It felt like the engine had just completely detached and fallen to the bottom of the ocean.
It felt that way, yeah. Because the rogue wave immediately triggered a catastrophic Force 2 reaction.
The crew lost their minds.
Exactly. Investor psychology just collapsed. Institutional algorithms triggered mass sell-offs, retail investors panicked, liquidity dried up. But here's the crucial distinction Scola makes.
Okay.
The engine Force 1 was severely disrupted, sure, but it wasn't destroyed.
Right. I mean, supply chains were a total mess. Physical retail was shut down. But the fundamental infrastructure of the global economy was still there. The digital infrastructure, consumer demand, human ingenuity, all of that was intact.
Exactly. Central banks stepped in to provide liquidity, essentially acting as mechanics for the engine. And because the underlying fundamentals were resilient, the market didn't just recover that 30% drop by late 2021.
It was way past it.
It reached entirely new all-time highs. The ship righted itself.
Wow. Which really exposes the greatest tragedy for everyday investors during a crash, doesn't it?
It really does.
Like the moment you log into your app and hit sell during that 30% drop, you are literally locking in a temporary psychological panic as a permanent mathematical loss.
You're jumping overboard right before the ship stabilizes.
And that's exactly it.
You're abandoning the fundamentals because you got spooked by the crew. That's why Scola argues so strongly that short-term fear does not equal long-term loss. Unless, and this is key, unless you actively choose to execute a trade based on that fear.
Okay, so we understand how fear drives the floor falling out. Let's flip the script for a second and look at the ceiling.
Okay, let's do it.
Because if fear causes these massive crashes, then, well, unrestrained greed has to be what causes the massive spikes, right?
Oh, absolutely.
So how do we spot when the mood of the crew has become dangerously euphoric? Because when a stock you own is up like 200%, it doesn't feel like a dangerous psychological anomaly. It just feels like you're a genius.
It feels incredibly validating, which is exactly why bubbles are so lethal. A bubble is simply what happens when Force 2 investor psychology completely hijacks the engine.
Enthusiasm totally detaches from reality.
Yes. Scola spends a significant portion of this chapter outlining 4 specific warning signs to help investors, identify when they are caught in a hype cycle.
Okay, lay them out for us. What's the first sign we're drifting away from the fundamentals?
Sign number 1 is the most mathematically obvious. Prices rise significantly faster than fundamentals.
Okay, give me an example.
So, you might see a company's stock price surge by 500% over a single year. But when you look at their actual balance sheet, their revenue has barely moved and their profit margins are shrinking.
The price is completely detached from the engine's output.
Exactly. The price is just floating away.
It's just speculative air inflating the valuation then. People are paying for a future that mathematically cannot exist based on the current trajectory.
Spot on. Now, sign number 2 is broader mainstream saturation. Basically, everyone is suddenly talking about it.
Oh, I know this one.
Yeah, it's the classic historical indicator. It's when you start getting incredibly confident stock tips from your taxi driver, your barber, or, your cousin who has never mentioned capital markets in their entire life.
Okay, wait, let me push back on this a bit.
Sure.
Because on the surface, this sounds a little like Wall Street gatekeeping. I mean, isn't it fundamentally a good thing when retail investors, everyday people, are democratizing the market and participating in wealth creation?
That's a really fair question.
Why is mainstream participation inherently a warning sign of a bubble?
It's a critical distinction to make, and I'm really glad you called it out. The warning sign has absolutely nothing to do with looking down on everyday people participating. It's not about that at all.
Okay, so what is it about?
It is entirely about the flow of information and the basis of the trade.
What do you mean by the basis of the trade?
Well, when institutional analysts or seasoned value investors buy an asset, they are typically doing it based on fundamental analysis, right? They've modeled the cash flows.
Right, they're looking at the engine.
Exactly. But by the time a highly speculative asset reaches the barber or the taxi driver, the information chain has completely degraded.
Oh, I see where you're going with this.
Yeah. They aren't buying because they've analyzed the debt-to-equity ratio. They're buying purely based on momentum. They're buying because the line went up yesterday.
Wow.
And when the very last people in the information chain are buying based solely on the fact that the price is rising, there is simply no new capital left to enter the system and push the price any higher.
Ah, I get it now. It's not about who is buying. It's the fact that the buying pool has just exhausted itself on pure momentum rather than any underlying value.
Exactly. The fuel is gone.
That makes complete sense.
Which leads directly into sign number 3. And this is perhaps the most dangerous psychological trap of all. Stories replace numbers.
Ooh, narrative economics.
Precisely. During a bubble, people stop justifying a valuation by saying, They have a stable 15% return on invested capital.
Right, they stop using math.
Yes. Instead, they start saying, this new technology is going to fundamentally alter the fabric of human society, so traditional valuation metrics no longer apply.
The classic, this time it's different trap.
Every single time.
It is so seductive, though, because human beings are biologically wired for storytelling. I mean, we survived for millennia by passing down narratives around a fire.
Oh.
We did not evolve to intuitively grasp compound interest
We definitely did.
or price-to-earnings ratios. A spreadsheet creates a mathematical ceiling on what a company is worth.
But a story has no ceiling.
A story has no ceiling. That is a great way to put it, and that is exactly why bubbles inflate so rapidly. Which brings us to warning sign number 4. That storytelling fuels FOMO.
Fear of missing out.
Fear of missing out dominates. It is that overwhelming visceral anxiety that everyone else is getting rich effortlessly, and if you don't buy in this exact second, you will be permanently left behind.
And when FOMO takes over, any rational thought about Force 1 fundamentals is just thrown right out the window.
It's completely overridden. And Scola is so emphatic about this.
Yeah.
Chasing these narrative-driven bubbles is a mathematically losing strategy over a lifetime of investing.
Because the bubble eventually pops. Right. When it bursts, the price violently snaps back to where the fundamentals actually reside. It always returns to the engine.
It's fascinating to break this down intellectually, but let's be entirely honest with ourselves for a minute.
Okay.
Sitting here, calmly dissecting market mechanics, it is very easy to say, just stick to the fundamentals and ignore the hype. But in the real world, it is agonizingly difficult.
Oh, it's incredibly hard.
Right. I mean, I don't naturally wake up in a cold sweat worrying about the S&P 500's aggregate earnings. So where are these overwhelming feelings of FOMO and panic actually coming from? What is stoking Force 2 so aggressively?
You really have to look at the environment you're operating in. The answer is the modern media ecosystem.
The news.
Yes. We are no longer waiting for the morning paper to see closing prices. We are subjected to a constant, unrelenting barrage of information.
Literally in our pockets.
Exactly. Financial apps push notifications to your lock screen. Social media algorithms serve you these highly emotional takes. YouTube thumbnails feature people making exaggerated panic faces.
The volume is just dialed up to 11, 24 hours a day.
And as an investor, you have to understand the business model of that ecosystem. The financial media does not get paid based on your long-term portfolio returns.
They get paid on clicks.
They get paid based on your attention. They monetize your engagement. And behavioral psychology tells us that human beings are far more likely to click on a terrifying threat or an unbelievable opportunity than, say, a measured analysis of quarterly earnings.
So they're structurally incentivized to manufacture panic and hype.
Absolutely.
They are essentially mining Force 2 for ad revenue. It reminds me of checking Twitter on a random afternoon. You see a trending headline that literally screams, "Markets tumble, investors flee," and your heart just drops.
You think the system is collapsing.
Right. And then you pull up the actual index, and the S&P is down like 0.8%. It's entirely normal, mundane, daily volatility, but it's packaged as an existential crisis.
Or you see the exact opposite. You see a headline screaming, once-in-a-generation buying opportunity. But when you actually look at the chart, the asset is already up 300% over the last 6 months.
Oh, man, yeah.
The media is literally selling you the peak of a bubble as if it's the ground floor.
It is like listening to a truly unhinged sports commentator on the radio.
How do you mean?
Well, imagine you're driving, listening to a soccer match, and the commentator's just screaming at the top of their lungs, "He passes the ball. It's moving across the midfield." This is absolutely historic.
You'd assume you're listening to the final seconds of the World Cup.
Exactly.
Yeah.
But if you actually turned on the television, you would see two guys doing a totally routine, boring pass in the first 3 minutes of a Tuesday night exhibition game.
That analogy perfectly captures the mismatch because the commentator's timeline is second by second. They need you emotionally invested right now so you don't change the station.
Right.
The financial media operates on that exact same micro timeline. But wealth building operates on a multi-decade timeline.
Those do not mix well.
No, they don't. When you mix the two, you get terrible decisions. If you react to the tone of the commentator rather than the actual play on the field, you will destroy your portfolio.
Okay, so how do we filter this?
Yeah.
Because we can't just, move to a cabin in the woods and never look at the news. We need to know when actual external shocks are happening.
Scola's rule for this is brilliantly simple. You must train yourself to treat financial news strictly as information and never as a call to action.
Okay. Information, not action.
Consume the data, understand the geopolitical landscape, be aware of the external shocks, sure, but never let a headline dictate the exact moment you hit buy or sell.
I love the discipline in that. Treat it as information, not an instruction. And I have to bring us back to the reality of a genuine crash here.
Sure.
Not a 1% dip manufactured by a headline, but a real prolonged 20 or 30% bear market.
The scary stuff.
Exactly. When you are logging in week after week, and your net worth is visibly shrinking, and your friends are texting you saying they've liquidated everything into cash just to sleep at night, the psychological pressure is suffocating.
It really is.
How does an investor fundamentally survive that test of character?
It is arguably the hardest psychological feat in modern life. To survive it, Scola says you have to anchor your mind to long-term market reality.
Long-term reality.
Yes, you have to actively force your perspective past the current rogue wave, past the panicked crew, and look exclusively at the historical data of the engine.
Because the engine keeps going.
Because despite every bubble that has ever burst, and despite every terrifying crash we have ever endured, the broad markets persistently, relentlessly grow over the long term.
Let's talk about the hard math of that growth. Because when you are losing money today, long-term feels like a theoretical concept.
It feels like forever.
It does. What actual data does Scola point to that proves this resilience?
He highlights 3 historical averages that essentially serve as the gravitational pull of the financial world. And honestly, every investor should have these burned into their memory.
Okay, lay them on me.
First, the S&P 500 has averaged a roughly 10% annual return since 1926.
Wait, just pause on that year for a second. 1926?
Yeah.
That timeline includes the Great Depression, World War II, the stagflation of the 1970s, the dot-com collapse, the 2008 global financial crisis, and a global pandemic.
All of it.
And through all of that unimaginable human chaos, the underlying engine still averaged 10% a year.
It is staggering when you frame it that way, isn't it?
It really is.
Second, if you look at the FTSE All-World Index, which captures a much broader global economic footprint, it has averaged roughly 8 to 9% annually since the 1980s.
Okay, so that's the global view.
Right. And third, for the more conservative anchor of a portfolio, global bonds have historically averaged between 3 and 5%.
So 10% for the S&P, 8 to 9% globally, and 3 to 5% for bonds. But why?
What do you mean?
I mean, why does a broad index like the S&P relentlessly march upward despite all the terrible things that happen in the world? It can't just be magic.
Oh, it's definitely not magic. It's actually a ruthless Darwinian mechanism.
Darwinian?
Yeah. A broad market index is not a static list of companies. It is self-cleansing. When a company fails to adapt, when its fundamentals collapse, its stock price drops and it gets kicked out of the index.
Oh, right. It gets replaced.
Exactly. It is immediately replaced by a faster, more innovative company that is capturing market share.
That makes a lot of sense.
Furthermore, corporate earnings inherently capture human ingenuity, population growth, and crucially, inflation. As the cost of goods goes up, these companies charge more, which drives their revenue higher.
It's basically a machine designed to continually capture human progress.
That's a great way to summarize it.
Which brings me to a realization about how we behave during a crash. When the market is down 20%, the media is screaming, and your instincts are telling you to run. Choosing to do nothing feels like an act of surrender.
It feels incredibly passive.
It does. But when you understand the mechanics we just talked about, doing nothing isn't passive at all. Holding your position is an incredibly active, intellectually demanding act of defiance.
Exactly. Doing nothing when your amygdala is screaming at you to act requires supreme willpower. And that circles back to the core lesson of the leaking pound.
The real takeaway.
A market crash is not the end of the financial world. It is simply a stress test of your discipline.
I love that.
It is the market asking you, do you actually believe in the mathematical reality of long-term compounding, or were you just participating for the dopamine hits of a bull market?
Wow.
Crashes are an inevitable temporary feature of the system. Long-term fundamental growth is the permanent reality.
What an incredible framework to walk away with. I feel like we have completely dismantled the terror of that jagged red line today.
I hope so.
We've looked under the hood at the 3 core forces: the undeniable engine of economic fundamentals, the chaotic, emotional crew of investor psychology, and the unpredictable rogue waves of external shocks. We explored the mechanics of a bubble, recognizing that when narrative economics and FOMO replace actual balance sheets, you are standing on a trapdoor.
A very dangerous trapdoor.
And we learned to view the frantic sports commentators of the financial media not as advisors, but as noise capitalizing on our loss aversion. And ultimately, we anchored ourselves to the ruthless, self-cleansing historical reality of long-term market growth.
It really transforms investing from a game of guessing into an exercise in endurance.
It does.
And I actually want to leave you with one final, slightly provocative thought to consider based on our deep dive today.
Oh, let's hear it.
If we know that bubbles are constructed almost entirely out of seductive narratives, and we know that crashes are ultimately just a mechanism to separate the disciplined from the panicked, take a hard, honest look at your own portfolio today.
Look at what you're actually holding.
Exactly. Look at every individual asset you own. Are you investing in mathematically sound, cash-generating engines, or have you just bought into a really good story?
Oh, wow. That is the exact question every investor needs to answer. Are you holding an engine or a story?
Exactly.
Well, thank you all for joining us on this deep dive into Gregory Scola's work. The next time you open your app and the screen is red, remember, it is not a personal attack. It is just the crew overreacting to a wave. Trust the engine, ignore the noise, and stay disciplined out there.